Good afternoon, everybody. Thank you for joining the SCVMA COVID Complementary Continuing Education Series. We'll be getting started in about 10 minutes or so. Feel free to load up with your beverage of choice in the middle of the afternoon. And we will go ahead and introduce DVM and their speakers in just a few minutes. So thanks so much for joining us today. We appreciate it. Hello, Brianna. I see your name, but not your face. You too, Bob.
Hi, Mr. Peter. Bob Hyman here. Can you hear me?
I can hear. Welcome. You sound good. And looks like David is trying to get logged into the audio side of things. Thank you for your support on this, Bob and Brianna.
Well, Peter, we always thank you. What are you talking about?
It's Dave Leckey on the line now.
Hello, Dave. You should be able to start sharing your screen if you'd like and bring up your first slide.
Sounds good. Let me see if I can.
We'll get started in about 7 minutes. For those of you who have logged in, thanks for joining us. Make yourselves comfortable. We'll be rocking and rolling in just a few minutes.
How does that look, Peter?
We have a picture of a dog and a slide that says defer. No, you're moving too fast for me to read. Tax planning for the pet health professional.
That's the starting slide.
Perfect. Perfect. Looks good. You can start your own video if you want to have your picture next to the slides. Otherwise, you are right at the perfect place to get started.
Perfect. Sounds good. Thank you.
Not a problem. I'll do some brief intros at 12:30. In the meantime, Bob, Brianna, and David, you're free to mute your microphones in case you sneeze, snort, or make other body sounds.
You got it.
Okay, Peter, I'll mute over here.
All right.
Peter, how's my audio? Loud and clear?
Your audio sounds loud and clear. Thank you.
All right, perfect. Just checking.
Nope, doing good. Doing good. And Lynn is here to keep us honest because she knows I get distracted. I'm like the dog that chases after every moving object. So she
Squirrel!
right. For those of you who have logged in, if you want to say hello in the chat, feel free to do so. We've got a good turnout so far, and it's still a bit early. Chat to say hi. We won't call you out, but thanks so much for being a part of today's program. Everybody should be muted except for the hosts and co-hosts. So those of you who are on as participants are going to be muted. We'll be able to use the chat feature as well as the Q&A feature that you should see. It's the item at the bottom of your screen if you move the mouse down there to either chat or ask questions, or you can formally use the Q&A for questions. David, how would you like to handle questions during the presentation or at the end?
I think probably the end. I mean, I do have I do have a good amount of information to go over. All of it being very relevant and good. So I think if that's okay, if we could hold the Q&A to the end.
Not a problem. You can focus on your presentation and we'll handle the Q&As that come up at the end. So not a problem. Thank you.
Sounds good.
Just the right questions when Q&A will happen. This is as good as any, Gregory. You can use this one, or there is a Q&A option that you can see at the bottom as well. About 4 choices to the right of chat is 2 little bubbles that you can use for Q&A. Either place will be perfect for Q&A that might come. All right. The big hand is on the 12. Excuse me. The big hand is on the 12:30 here in Southern California. 19. Thank you so much for joining us for this week's installment of the SCVMA Complimentary COVID-19 Continuing Education Series. Let's see, logistically, the bottom of your screen has a chat option and a Q&A option. You can use either of those to engage with the speaker. The speaker will be answering questions at the end, so feel free to stack them up and we will get to them at the end. This program has been approved for 1 hour of California statutorily approved CE. Tomorrow, not today, not this afternoon, but tomorrow, you will receive an email from Zoom, not from me and not from a membership desk, but from Zoom, that will have a link to an evaluation form, and once completing the evaluation form, to a CE certificate. If you have any problems handling the email from Zoom, if you don't get the email from Zoom, or if you really just want to reach out and say hi, you can do so at membershipdesk@scvma.org. Membershipdesk@scvma.org is your place for problem solving when it comes to continuing education. So I will repeat it. You will not get it today. If you do, you shouldn't be. You'll be getting it tomorrow. In the meantime, I am honored, thrilled, pleased, and really, it's my pleasure to welcome Brianna Hyman and Bob Hyman from Diversified Veterinary Management, who are the hosts for today's presentation. I'm going to hand it over to Bob to say a few words and then introduce today's speaker. Bob, thank you so much for your support, and thank you for your now 41 years of support of the veterinary profession.
Well, we thank you, first of all, Peter. And what do they say? That's my high school picture on the web. So before I introduce David Leckey, our speaker, I just want to introduce the topic. And it just cannot get any better. It's all about tax, tax, and more tax. So just think of tax on steroids. And the nature of the discussion today is just going to be a helicopter view. Think of taxes today like playing any game, and they keep changing the rules all throughout the game. So it's a very difficult year for 2020, and David's just going to give you some highlights of things that could help you as a practice owner, as an associate, as a coworker. And I just have to remind everybody what they say, these tricks should not be performed at home, only should be done by a trained professional. So again, a lot of people like to do their own taxes. I think 2020 is not the year to horse around. Speaking of trained professionals, I do want to introduce David Leckey. David's been a California CPA for 15 years, has a master's in tax. And the exciting thing is he's had 7 years of employment at DVM Management. And again, DVM Management, as Peter said, we're 41 years old, getting ready for 42. We are an exclusive accounting, tax, business advisory for the pet health profession. And the exciting thing is, Mr. Leckey is top dog on the beach, and that's kind of his dog right there. So I'm going to turn the microphone over to Mr. Leckey, and he'll give us a helicopter short summary of taxes 101, taxes for tax year 2020. So Mr. Leckey, I think we're very lucky to have you speak today, so the microphone is yours.
Thank you, Bob. I am lucky to be doing this. Bob, I appreciate the introduction, the kind words, and Peter, I appreciate this opportunity to take part in the SCVMA Continuing Education Series, and hopefully share some knowledge that about taxes that everyone in the audience maybe hasn't heard yet, that can help reduce the overall tax burden. So that's kind of my goal today. I got a lot of information to go over, so I'm just going to kind of get right into it. But as Bob said, I just kind of want to go over some recent tax law changes that were implemented by the CARES Act. And then there's also some other potential forthcoming pandemic-related tax changes as well. And I say potential because as I was preparing this presentation, and most of you know, Congress is still currently kind of grappling with each other on trying to pass a second stimulus package, all while our president is kind of sidestepping Congress and implementing some of his own tax measures as well. So Here we go. These are going to be my focal points of discussion today. Again, just going to go over the CARES Act and just give a little bit of background. Second, go over the retirement provisions enacted by the CARES Act, kind of who qualifies and the specifics on the tax-favored withdrawals. And then next, talk about the PPP loan tax implications as it applies to business owners, and then move on to deferral of employer and employee Social Security payroll taxes, retirement plan startup cost tax credit under the Secure Act, stimulus checks. Possibly if you missed the first round, there's always a possibility to get them in on your 2020 tax return, so we'll talk about that. Roth IRA conversions. Now might be the best time to undergo this, especially if you've got some regular IRAs and 401ks that are kind of decreased in value due to the stock market volatility. Next, we'll move on to tax loss harvesting, talk about how to turn investment losses into tax breaks. And then we'll move on to some student loan fringe benefits. And then we'll talk about universal charitable donations as above-the-line deductions, not as deductions on your Schedule A itemized deductions. And then last but not least, we'll go over President Trump and Joe Biden's proposed tax policies and the impact that they may have on future taxes. Okay, so the Coronavirus Aid, Relief, and Economic Security Act of 2020, also better known, of course, as the CARES Act, was a $2.2 trillion economic stimulus bill passed by Congress and signed into law by President Trump in March of 2020 in response to the economic fallout of the COVID-19 pandemic in the United States. Now, the legislation was the largest economic stimulus package in U.S. history, amounting to roughly 10% of U.S. GDP. And this bill was, of course, much larger, almost 3 times as large as the $831 billion stimulus package that was passed back in 2009 as part of the response to the Great Recession. Here's a little simple breakdown of kind of the allocation of the $2.2 trillion of the CARES Act. As you can see, it's pretty spread out, but the focus today is mainly going to be on small business loans, also known as the PPP loans, and then household payments, which are the stimulus checks, and then, of course, the tax deferrals and tax credits. Okay. The CARES Act provides for special distribution options for retirement plans, including 401ks as well as traditional rollover and Roth IRAs. Now, the details on this provision are as follows. Coronavirus-related distributions, also known as CRDs, of up to $100,000 may be taken from eligible retirement plans between January 1st and December 31st of 2020. Now, the highlight of this is that the 10% early withdrawal penalties for those under the age of 59.5 does not apply to any CRD. There's no guidance as of yet on whether or not the state of California will conform to the Fed treatment because the state of California has their own 2.5% early withdrawal penalty at the state level. But generally, if you qualify for an exception for early withdrawal penalty at the Fed level, California will usually honor it as well. However, at this time, there's no clear guidance on this matter, so just keep that in mind. Distributions will be included in gross income for income tax purposes ratably over 3 years beginning in 2020. So, you also have the option of taking it all if you want as taxable income in 2020, which may be to your advantage if 2020 is a bad year in terms of if you're laid off or your hours are reduced or you took a pay cut or something like that and your 2020 overall taxable income is lower, it might be wise to take it all in 2020. If not, it's taken equally a third, and a third over the next 3 years beginning in 2020. Now, distributions may be repaid at any time during the 3-year period. If you pay the distribution back within the 3-year period, you can file a refund of the taxes you paid on those distributions. For example, if you received a CRD in 2020 and you choose to include the distribution amount in income equally over the 3-year period, and then you choose to repay the full amount on the very last day, being December 31st of 2022, you may then go back and file amended income tax returns for 2020 and 2021 to claim a refund of the tax attributable to the amount of the distribution that you had to include in income for those years. And then, of course, you will not be required to include the CRD income at all on your 2022 tax return. So, who qualifies for this provision? Per the IRS Notice 2020-50, a qualified person is defined as any one of the following 3. An individual who is diagnosed with COVID-19 by a test approved by the CDC, an individual whose spouse or dependent is diagnosed with COVID-19 by a test approved by the CDC, or an individual who experiences adverse financial consequences as a result of being quarantined, furloughed, laid off, or having work hours reduced due to COVID-19, being unable to work due to lack of child care, closing or reducing hours of business owned or operated by the individual due to COVID-19, or having a job offer rescinded or start date for a job delayed due to COVID-19. Now, some interesting facts about, or that we should also consider regarding the coronavirus distributions, is that the IRS guidance clarifies that the CARES Act does not limit CRDs to amounts withdrawn solely to meet a need arising from COVID-19. So, in other words, an individual is a qualified individual by simply just testing positive, or a spouse or dependent testing positive for COVID-19, and you don't necessarily have to have a financial need. Conversely, even if your spouse or dependent haven't tested positive for COVID-19, let's say your spouse experiences financial hardships such as reduced hours or a pay cut, then you are considered to have a financial need, even if you yourself have been unaffected financially with your job whatsoever. So even though there appears to be some strict guidelines who qualifies for a CRD, here I want to share this with you, what I read on the irs.gov in the Q&A section related to this. It says, the administrator of an eligible retirement plan may rely on an individual certification that the individual satisfies the conditions to be a qualified individual in determining whether a distribution is a coronavirus-related distribution, unless the administrator has actual knowledge to the contrary. Although an administrator may rely on the individual certification in making and reporting a distribution, the individual is entitled to treat the distribution as a coronavirus-related distribution for purposes of the individual's federal income tax return, only if the individual actually meets the eligibility requirements. So, just kind of reading between the lines here a little bit, but in my opinion, it seems like this is more or less on the honor system, as it would be very difficult for the IRS to accurately administer some type of qualification process solely based on point number 3 being they're trying to prove adverse financial consequences. Now, one of the things I also want to mention on this is that using cash from a retirement account should always be used kind of as a last resort. But, there are scenarios when it could make sense to take a CRD potentially if you don't necessarily need it for financial reasons. Say if you're, maybe considering using high interest rate credit cards or personal loans, then it might make sense to use cash as a CRD from your retirement account as a better option. And here's why, is that you'll have 3 years to pay back yourself interest-free compared to paying down high-interest credit card debt or a high-interest loan. Of course, one of the potential drawbacks of taking the money out of your retirement account is that, you may miss out on any future gains on your investments, or conversely, depending on how you see things going over the next 3 years, If the market does decline over the next 3 years and you get back in, you're going to be at a lower cost basis, which will be in a much better position financially. Of course, I'm not going to speculate on which way the market is headed or anything like that. I think that's a conversation best had with your financial planner or strategist. All right, moving along, the Paycheck Protection Program, also known, of course, as the PPP loan program, is a loan designed to provide a direct incentive for small businesses to keep their workers on payroll during the COVID-19 pandemic. While most business owners are, I'm sure, aware of this program and the potential loan forgiveness aspect, what I think is not really being addressed enough is the potential tax implications for the borrowers. On April 30th, the IRS released Notice 2020-32, which effectively denies borrowers the ability to deduct the same expenses that qualify them for the loan forgiveness. The notice argues that Code Section 265 of the code disallows what would ordinarily be allowable tax deductions for the amount of any payment of an eligible business expense to the extent of the resulting covered loan is forgiven. The IRS is basically taking the position that allowing businesses to deduct these expenses would result in business owners receiving a double benefit. Now, you're probably, I know all this is very difficult jargon, you're probably thinking this is about as clear as mud. So, in layman's terms, if you use the PPP loan funds to pay for payroll, rent, utilities, and eligible expenses, then essentially you can't take a tax deduction for those amounts if your PPP loan is forgiven. Okay. So here's an example. Let's assume a business owner will end up doing the same level of business in 2020 as they did in 2019, which is the $100,000 of taxable net profit. Just kind of using some round numbers here and keeping things simple. Let's also suppose that they receive a $30,000 PPP loan that was used 100% for payroll and other eligible expenses, and they're able to get full loan forgiveness of the $30,000 loan. Now, because the $30,000 was used on expenses that were PPP loan funds and the loan was forgiven, these expenses aren't tax deductible. And as a result, the net profit, taxable profit, will be $30,000 higher in the year due to not being able to deduct these expenses, which is effectively making your 2020 taxable net profit $130,000. So it's $30,000 more than the previous year. Now, the main reason why I feel this should get more attention is because it relates to your 2020 estimated tax payments. That if a taxpayer has only been paying in 2020 quarterly estimated tax payments based on 2019 taxes, when the net taxable profit was only $100,000, you're going to have a much larger tax bill for 2020 because now your net taxable profit is $130,000. Now at this point, hopefully the taxpayer is working with their CPA, and the CPA has been communicating with him or her in regard to this potential additional tax bill coming due on April 15th of next year, 2021. If not, then I would say a good rule of thumb is to set aside roughly 40 to 45% of the PPP loan amount for taxes. Assuming like a 30 to 35% Fed tax bracket and a 10% California bracket. Of course, it'll be different if you live in a different state. This might be one way to avoid a cash crunch, come April 15th of 2021, or some possible solutions to alleviate and reduce your 2020 tax bill would be to, the tried and true ways of, deferring income into 2021 and accelerating expenses into 2020 by, prepaying vendors at the end of the year. You can also consider paying extra bonuses to employees or making more contributions to retirement plans, and what can have kind of a big impact would be take advantage of accelerated depreciation such as Section 179 or 100% bonus depreciation by purchasing additional equipment that's needed, or making interior tenant improvements or something like that. Okay. So now, this is obviously drawing a lot of, I don't know, bad press, or just it's making a lot of people unhappy. So I want to point out that there is potential for an update to the PPP loan program and its potential negative impact on 2020 taxes. The rules are still being written, and there's, several organizations out there that have kind of taken it upon themselves, one being the American Institute of Certified Public Accountants, or the AICPA, in addition with, roughly 170 other business and trade organizations, have been lobbying Congress to allow businesses to write off these expenses paid for with the PPP loans that have been forgiven. Now, the AICPA argues that the IRS, in issuing that notice back on April 30th, contradicts Congress's intent with the CARES Act when it passed the PPP loan legislation. So it is possible that future legislation may change the IRS rules on this matter, but for now I think it's a good idea to assume that you won't be able to deduct these expenses, and you may have a higher tax bill come 4/15/2021 as a result. All right, moving on to our next point, I want to talk about the deferral of payroll taxes. The CARES Act allows employers to defer the deposit and payment of the employer share of Social Security taxes. Social Security tax, of course, equates to 6.2% of gross wages, the employer portion of wages for all the employees, for wages paid between March 27, 2020 and December 31st of 2020. Half of the deferred amount isn't due until December 31st of 2021, with the other half not being due until December 31st of 2022. And of course, if these are not made, then there's significant failure to deposit penalties. Now, there's no application process. You just have to work with your payroll service provider for implementation. But I think it's worth mentioning the potential income tax implication for cash basis taxpayers if you elect to utilize this tax deferral. While the ability to defer the employer share of payroll taxes may be helpful in the short term, to improve liquidity, deferring the payment will also defer the income tax deduction depending on your method of accounting. The deferral of the deduction could create a higher tax bill for 2020 for cash basis taxpayers, since as a general rule, expenses are only recognized and deductible when it is paid, not accrued. So if you defer the payment until 2021, the tax deduction won't be recognized until that year. Same goes for the other 50% if you deferred until 2022. These are some of the reasons that, in addition to the potential significant failure to deposit penalties, I would only utilize this provision possibly maybe as a last resort before you take on, maybe additional debt or something like that. So something definitely needs to be discussed with your personal CPA before you move forward on this. Let's now transition over to, there's the employee side. And so as a result of the inability of Congress to agree on the next stimulus package, President Trump, on August 8th of 2020, signed an executive action in the form of a memorandum directing, and I quote, the Secretary of the Treasury to use his authority to defer certain payroll tax obligations with respect to the American workers most in need, unquote. Most in need is defined as an employee whose wages payable during any biweekly pay period, which is 26 a year, generally is $4,000, or in other words, less than $104,000 in annual taxable wages for 2020. The deferral period is from September 1st, 2020 through December 31st, 2020. And it's important to note that the tax deferral is not the same thing as a tax cut. It does not relieve the employee of the obligation to ultimately pay the taxes. The memorandum indicates that, and I quote, the amounts deferred pursuant to the implementation of this memorandum shall be deferred without penalties, interest, additional amount, or addition to the tax, unquote. So in other words, the relevant payroll taxes could be paid later without penalty. However, it's possible that the taxes may not have to be paid back at all, as President Trump in the memorandum also stated, and I quote as well, here's the Secretary of the Treasury shall explore avenues, including legislation, to eliminate the obligation to pay the taxes deferred pursuant to the implementation of this memorandum, unquote. So it's very possible that further legislation may forgive the deferred portion of the employees' payroll taxes. This doesn't apply to the employer's payroll taxes. So keep that in mind. Another thing I want to mention is, this President Trump's actions is receiving quite a bit of criticism. For example, there's a lot of drawbacks, mainly for the employers in implementing this deferral for their employees is most likely going to be an administrative burden at best. Also, due to the uncertainty on this matter, employers may decide to do nothing, fearing that if Congress fails to act and forgive the employee taxes, they could be stuck trying to claw back money from their employees in 2021 by doubling up the amount of withheld Social Security taxes to settle their obligations to the IRS, which of course would most likely be a bad situation. Okay, next I want to discuss the Retirement Plan Startup Cost Tax Credit, and this is something that was actually implemented under the Secure Act, which was actually passed into law December 20th, 2019, which was before the pandemic, but it's still worthy to mention as it's still applicable today. Now, Secure stands for Setting Every Community Up for Retirement Enhancement. So the initiative here was, many small business owners face hurdles such as installation costs, administrative fees, and compliance requirements in establishing a retirement plan for employees. So in response, and in order to encourage employers to establish these plans, a tax credit of $5,000 per year is available for 3 years, which will cover 50% of the administrative costs of implementing a plan for employers with 100 or fewer employees. Now, the tax credit is only available when an employer is establishing a new retirement plan. And this includes a 401k plan, profit-sharing plans, cash balance plans, simple IRAs, and so forth. It's also important to note the tax credit, it's not a deduction, it's a credit in that, let's say it equals $2,000, well then it will reduce the employer's tax liability dollar for dollar by $2,000. Okay, stimulus checks. If you did not qualify for a stimulus payment authorized by the CARES Act because your adjusted gross income, or AGI, was too high in 2018 or 2019, you might qualify for it in 2020 when you file your tax return. If your AGI has declined, or you can make some tax moves to get your 2020 AGI below the thresholds. So the stimulus payment is actually based on the tax return for 2020. It's not based on 2018 or 2019. It was just the Treasury Department had nothing else to go off of, so that's why they utilized your 2018 return if your 2019 return was still an extension, or if you'd already filed your 2019 return, they used that instead. So for 2020, there's most likely going to be a worksheet with your IRS Form 1040 that reconciles your income and will add the CARES Act credit as a refund if you do end up qualifying in 2020. Now, fortunately, if your AGI went up in 2020 and you would no longer qualify, you will not be asked to return the stimulus check. So if your 2018 or 2019 tax returns had a lower AGI below the threshold, which was $99,000 for individuals, $198,000 for married couples, and you did receive a stimulus check, but your 2020 tax return will show that your AGI is over the threshold, you won't have to give back that check to the IRS. Okay. All right, next topic is Roth IRA conversions. And I want to discuss this strategy mainly just because 2020 might be an ideal year to consider this option. Like I was saying, with the stock market, the volatility that's been experiencing this year, it's a possibility that your tax-deferred accounts, whether they're a 401k or an IRA, the value could be down overall. This of course depends on which kind of industries you've decided to put your stocks in. Hindsight being 2020, this strategy would have been perfect to implement, back on March 23rd when the markets hit bottom. But because since then, most of you have seen, we've had quite a significant rebound in the stock market, especially in the NASDAQ and S&P 500. However, if your portfolio may have been more heavily allocated to the industries that have been hit hardest by the pandemic, such as airlines, hospitality, gaming, clothing retail, REITs, which is real estate investment trust, banks, energy and utility stocks, most of those are still trading around their 52-week lows. So it still might be an optimal time to take advantage of a Roth IRA conversion. And as I'm sure when you do convert a traditional IRA or a 401k, a tax-deferred retirement account, to a Roth IRA, it is a taxable event, and the value converted is the amount that's taxed as ordinary income, subject to your marginal tax rates, not the lower capital gains tax rates. So there's numerous variables to consider in addition to market timing in regard to doing a Roth IRA conversion. So again, definitely something that needs to be discussed with your CPA before you make a move on this. Now, the rationale, of course, behind this strategy is that when you do the conversion, you're taxed on the lower value. So you pay the tax now on the lower value, which means less taxable income and, of course, less tax. But when the market eventually and hopefully rebounds for these industries that have been hit the hardest, all the upside gain and appreciation not only maintains its tax-deferred status, but also the funds are tax-free when drawn out of retirement. It's something worth considering, and of course you still have 4.5 months left in 2020 to figure out whether this is a good move or not. Now, something to definitely consider as well. Tax loss harvesting. Okay. So this is the next topic I want to go through, and I'm sure it's a concept that most everybody's heard of before. Usually something your financial planner handles kind of closer to year end. But like I was mentioning in the previous section, that there are some industries that were hit hardest by the pandemics, and you may have some stocks in those industries, and if they're still trading around their 52-week low, could be an ideal time for you to do some tax loss harvesting. If you do have positions, and we're talking about taxable accounts here, and you've got some unrealized losses, you should consider harvesting the loss for a tax break. Unfortunately, the IRS did put a limit on the amount of capital losses that you can deduct each year. Basically, to the extent your realized losses exceed realized gains in any given year, you can only take a maximum of $3,000 of capital losses that can be applied towards your ordinary income, such as W-2 wages, interest, or business income. And then, of course, the excess produces a capital loss carry forward to be used in future years. And, of course, in those future years, it's still limited to $3,000. But I think this is, especially helpful if you're in higher marginal tax brackets to utilize this strategy. However, do be mindful of the wash sale rule. This rule states that a loss cannot be realized for tax purposes if a substantially identical position was bought 30 days before or after the sale. Fortunately, there are some ways to get around this rule. For example, let's say on December 30th of 2020, you simultaneously sell your entire position in your Marriott stock, and then buy stock in Hilton using 100% of the proceeds from the sale of the Marriott stock. Your entire capital loss in Marriott is realized for tax purposes in 2020. But in theory, both Marriott and Hilton should benefit relatively the same from an industry rebound or a COVID-19 vaccine. So you shouldn't be any worse off owning Hilton versus Marriott when the market does, hopefully rebound for these industries. Now, this same strategy can be utilized not just for individual stock positions, but for ETFs and mutual funds as well. So, for example, let's say you own a SPDR ETF that tracks the Dow Index. Well, you can simultaneously again sell that ETF, SPDR ETF, and buy a position in an iShares Dow Index ETF, and you're basically still avoiding the wash sale rule because they're two totally separate companies offering the same ETF that tracks the Dow Jones Industrial Average Index. But when you sold your position out of the SPDR Dow ETF, you get to recognize any losses for tax purposes in 2020. Okay, up next is a little-known fringe benefit tucked away in the CARES Act package for employers to provide tax-free payments on their employees' student loan debt. Specifically, Section 2206 of the CARES Act provides for an exclusion for certain employer payments relating to employee student loan debt in 2020. This is especially useful in that most veterinarians have accumulated some form of student loan debt. So I think this is of particular importance. So let's go over some of the details. The provision allows employers to subsidize or reimburse employee student loan payments up to an annual maximum of $5,250 per employee. Payments by the employer can be made directly to the lender or to the employee as a reimbursement upon providing acceptable documentation of loan payments made within the 2020 tax year. Qualifying direct payments to the student loan lender or reimbursements paid to the employees must occur by December 31st of 2020. Also, this only applies to employee loans. Of course, your spouse or your children's student loans do not qualify under this provision. Now, in my mind, this is considered, a win-win tax strategy in that the payments are tax deductible for the employer and excluded from taxable income for the employee, which means they're not reported on the employee's W-2. This effectively saves the employee from having to pay income taxes while providing the employer with a tax deduction as well as saving some payroll tax expense. Something to consider would be possibly to utilize this provision in lieu of maybe a year-end bonus. For example, say you're planning on paying an employee a $10,000 year-end bonus, so instead you pay $5,000 as a student loan reimbursement, assuming they've paid at least $5,000 at 2020, and then the other $5,000 as a bonus. Now, I also want to make sure that I mention that there is, some small administrative hoops that have to be hurdled before you can take advantage of this provision. The Internal Revenue Code Section 127 sets out the rules for what are called educational assistance programs, commonly referred to as 127 plans, which have mainly been used for tuition reimbursement. If you have a 127 plan in place, consider expanding the program for 2020 to include the student loan debt repayments. And of course, you've got to notify the employees of the benefit. And also for, if you don't have a 127 plan in place, consider adopting the written program for 2020, which can be just limited to just repayment of student loans. The educational assistance programs, they're easy to set up as they're basically just internal documents retained and signed by the employer and employee, which you can find, there's a number of templates can be found online with a simple Google search, using 127 plan document. As of now, this provision only applies to the 2020 tax year, but Congress may extend this relief beyond 2020 as provisions as advocates of the provision say, including this option in the stimulus package could open the door for it to be more widely implemented among companies. So it's possible for this provision, to become permanent even after it expires, as it's often difficult, to pull back a tax break once it is already in place. Okay, moving along. Charity. So, for decades, the rule was that individual taxpayers could deduct charitable contributions only if they itemized their personal deductions on Schedule A instead of taking the standard deduction. If you don't itemize, you don't get any charity deduction. The fact is that more than half of taxpayers donate money each year, and most of them get no tax benefit from it at all. In addition, what has amplified this dilemma is the Tax Cuts and Jobs Act, the TCJA, which went into effect in 2018, and which effectively doubled the standard deduction. Pre-TCJA, the standard deduction was only $63.50 for single taxpayers and $12,700 for married couples. Post-TCJA, the standard deduction is $12,400 for single taxpayers and $24,800 for married couples. At the same time, the Act eliminated or curtailed many other valuable itemized deductions, such as the state and local tax, also known as the SALT deduction, and the 2% AGI deductions. And as most California resident homeowners know, the $10,000 SALT cap limitation is especially devastating because most California homeowners reach the $10,000 cap with just real estate taxes alone, inevitably, rendering any California state income taxes paid as essentially non-deductible items where they used to be. So the end result is that post the TCJA, only 10% of taxpayers itemized their deductions, which was down from 30% pre the Act. So in other words, roughly only 90% of taxpayers, 90% of all taxpayers are unable to deduct their charitable contributions because of this. So for the 2020 tax year only, again, it could be extended, the CARES Act created the universal charitable deduction, which allows taxpayers who don't itemize deductions to deduct up to $300 for single taxpayers and $600 for married couples in charitable contributions as what are called above-the-line deductions. As usual, the charitable contributions must be in cash and given to a 501c3 public charity. But like I was saying, since it's above-the-line deduction, you don't have to file a Schedule A and itemized deductions to claim it. Instead, it's just listed as an adjustment to income on Form 1040 as a deduction from gross income. Okay, last but not least, let's discuss the different Trump and Biden tax proposals that have been put out there. First up, long-term capital gains tax. Under the current law, long-term capital gains tax is applied to assets held for more than 1 year, and the rates range between 0 to 20% depending on where your overall income lands. Trump has proposed to reduce the capital gains tax rate overall, although there are no specifics yet on this matter, and he can't do this without Congress's approval, although he may try to bypass Congress and has been talking about instead indexing capital gains for inflation. Now, indexing capital gains for inflation would lower capital gains taxes, not the rate, but just the taxes, because it would, for investors, it would adjust their original purchase price of the item in line with inflation, which is essentially making a portion of the gain exempt from taxes. So, for example, if you bought a stock 20 years ago for $100 and you sold it today for $150, you've got a $50 long-term capital gain. But by indexing for inflation, you'd pay taxes not on the $50 gain, but on $150 minus the inflation-adjusted value of the $100 from 20 years ago, which just happens to be $149.94, meaning that you would only pay capital gains tax on 6 cents. So it's a dramatic impact there. Biden, on the other hand, is looking to reduce the preferential tax treatment on long-term capital gains. Biden has proposed eliminating the Internal Revenue Code Section 1014 basis adjustment, which is also known as a step up in basis on transfers of appreciated property at death, which basically will tax unrealized gains at death. He has also called for taxing long-term capital gains and qualified dividends as ordinary income, just like wages. But it's only for those earning more than $1 million. At least that's what he's saying for now. This would essentially eliminate the preferential long-term capital gains rates, which are currently taxed at 0, 15%, or 20% federally, depending on where your marginal income tax brackets are. Now let's talk about federal individual income taxes. The current law is that the top marginal tax rate is 37% for income over $518,000 for individuals and roughly $622,000 for married couples filing jointly. Rates are scheduled to increase to the pre-Tax Cuts and Jobs Act amounts after 2025. Trump's proposal includes enacting a 10% middle-class tax cut, which reportedly could include lowering the 22% marginal tax rate down to just 15%. For 2020, the 22% marginal tax rate applies to income over $40,000 and under $85,000 for individuals, and over $80,000 and under $171,000 for married couples filing joint. He has also proposed to extend the individual rates enacted by the Tax Cuts and Jobs Acts that are scheduled to expire after 2025. Biden, his proposal, he's also called for broadening the tax base, although the difference is that Biden proposes to lower tax rates for lower income levels, but for those earning over $400,000, he wants to increase the top federal income tax rate back up to 39.6% from the current 37%. Also, for those earning $400,000 or more, Biden's proposal includes the elimination of the Internal Revenue Code Section 199A QBI deduction, also known as the 20% pass-through deduction, which has been a big benefit for business owners. This isn't as much of a dilemma for veterinary business owners, as I'm sure you all know. We're considered specified service businesses, and there's already some income. We're already subject to some income limitations there as well. Just more of kind of an FYI, but California income taxes as well. It looks, and this really only applies for people making over $1 million, but I thought it was worth mentioning, is that there is a bill in review before the California Senate Governance and Finance Committee that would raise personal income taxes for California residents retroactive back to January 1st of 2020, basically the beginning of this year. The bill, labeled AB 1253, if enacted, would create 3 top millionaire tax rates, increasing the tax rate for those with income over $1 million from 13.3 to 14.3%, income over $2 million from 13.3% to 16.3%, and then income over $5 million, from 13.3 to 16.8%. Okay. And I'm running out of time here, so I'm going to go through this as quick as possible. But I wanted to just hit on some tax credits that each candidate is proposing. The current law for child tax credit is it can be claimed for dependents age 16 and under with a valid Social Security number. The maximum child credit is $2,000, and then there's also a $500 non-refundable credit for qualifying dependents. At the moment, there's no tax credit for first-time home buyers or renters. Trump's proposal includes a requirement that a dependent have a Social Security number to be eligible to be claimed for the 500 dependent credit. His proposal also required a taxpayer to have a Social Security number to claim both the child tax credit of $2,000 and the $500 other child dependent credit. And as well, he wants to extend the $2,000 child tax credit enacted by the Tax Cuts and Jobs Act, which is scheduled to expire after 2025. Biden's proposal includes actually raising the child tax credit to $8,000 for one child and $16,000 for two or more children for taxpayers with income under $125,000 per year. Now, the credit phases out for income between $125,000 and $400,000 per year. And he's also proposed enacting an advanced tax credit of up to $15,000 for first-time home buyers. And he's also proposed enacting a renter's tax credit designed to reduce rent and utilities to 30% of income for low-income individuals and families who make too much money to qualify for Section 8 housing. All right, last item I wanted to bring up, which is regarding the student loans, is that Biden, he's the only one really making a proposal on the student loans. But his focus is mainly on the income-driven repayment and student loan forgiveness for federal student loans only. Some of the highlights are borrowers earning, under $125,000. He's saying, he would forgive any undergraduate debt taken out at any 4-year or 2-year public institution. From what I've read, the student loans are likely to only include Stafford loans, which, as I understand it, are limited to no more than roughly $57,000 for 4 years of undergraduate college. Also, the income test would likely be on an annual basis to prevent borrowers from, coming in 1 year at under $125,000, and then, just to kind of game the system. Number two, a COVID-19 student loan forgiveness plan to cancel up to $10,000 in student loan debt for each borrower. Yep. I mean, you heard that right. It actually applies to everyone. The idea, or his idea, was that the pandemic crisis generated enough financial hardship across the country that forgiving $10,000 of student loan debt could aid in the recovery. However, the urgency, of the pandemic crisis, I wouldn't say it's behind us, but the talk is that there's less likely of a chance of this passing. Number three, Biden would reduce the income-driven payments on federal student loans from 10% down to 5% of discretionary income per year. The big question is whether he would make graduate and professional students pay the current income-driven payment rate of 10% of income, or if he would include this group in the change to 5% of discretionary income. That there's no clear guidance on that yet. Number four, after 20 years of on-time payments, borrowers would receive automatic student loan forgiveness, and it would be 100% tax-free. This could be especially helpful for professionals in the veterinary industry who almost always inevitably have to take on some hefty student loan debt. So cutting the monthly payment in half from 10% down to 5% would be a significant benefit. And then, of course, after 20 years, whatever balance to the student loan remains is forgiven tax-free. So a simple example, a veterinarian who has $300,000 in student loan debt while, only making $100,000, the annual payment would be capped at 5% or $5,000. So for simplicity's sake, assume you continue to make, this is an assumption, continue to make only $100,000 over the next 20 years. Well, 20 years times 5,000 is only $100,000 of total payments, which means that technically, as I read it, the remaining balance of $200,000 of student loan debt is forgiven, and it is 100% tax-free. So, this is just one slide I kind of thought of. What are some ways that we can deal with the potential tax rate, capital gains tax rate increase? Here's a couple of strategies, and this is the last slide. Is you can sell appreciated stocks that have been held for over 1 year to take advantage of the lower capital gains rate in 2020, in case it does change in future years, as more or less a hedge against, not qualifying for the capital gains rates in a future year. So if a taxpayer wants to maintain a position, in a stock, let's say, you could always sell it and immediately repurchase it because, as we discussed previously, the wash sale doesn't apply to gains. It only applies to losses. So you can essentially lock in your long-term capital gains now, repurchase the stock, and maintain your position. Another point is if you're considering selling a rental property or other real estate that you've owned for over a year, it might be appropriate to close the sale in 2020 if possible, while the capital gains rates are still low. More or less as a hedge against potentially being subject to the proposed ordinary income rates of 39.6 under Biden's proposal. So that's it. I think I took up probably more time than I should have. I apologize for that. I know I went over quite a bit of information, but let's go into the Q&A session.
Well, David, thank you so much for a fire hose of information. There was one question that I've seen so far that was the maximum salary to even qualify to do a Roth.
Maximum salary to qualify for a conversion
Yeah.
or a contribution?
Well, address both.
Okay, I think for a contribution, you run into some income limitations roughly around the 200,000 AGI mark. I don't know the exact details off the top of my head, but in regard to a Roth IRA conversion from a 401k or a regular IRA to a Roth IRA conversion, there are no income limitations there. However, be mindful that the income that you do convert, it's then taxable income at whatever your marginal tax rates are when you make that conversion. I'm not sure. Hopefully that is the answer to the question that was proposed.
Let's see, we got another question that just popped up. Can an employer make a payment through the business on their personal student loans and it still be tax-free?
I actually don't know the answer to that. Assuming that the business owner is in an S corporation where there's the 2% or greater limitations to virtually all of the fringe benefits, I would most likely lean more towards probably not. But I don't know a definitive answer on that.
Okay.
But that is some nice, thinking outside the box right there.
Well, I think we're seeing some of the corporations trying to find ways to pay down student debt for their employees. And I've got to believe independent practices will try to do and think about the same thing.
Yeah.
Next question. For paying employee student loans for the tax credit, for paying employee student loans for the tax credit, does that apply to RVTs for their technical programs as well?
Another one I don't know exactly, because the language that I read was more of a, there were some qualifications on the student loans in regard to the details. I would say if I can definitely look into it and get the details and reply back, if this attendee would like to send me an email, I can certainly provide them with the details. I vaguely do remember reading somewhere that it may apply, but again, I don't want to, I don't know the definitive answer on that one, but I can definitely certainly find out.
Part two was, does it make sense to pay the entire 5,000 limit or just what we'd have given as a bonus anyway? I'll tell you what, we'll get you these questions, and if you reply to them to me, we can share them with all the attendees. So
that'd be perfect.
The next question was, sorry I was late. Did you talk about relief work, independent contractor versus employer? Your opinion on, probably this goes to the Uber Lyft discussion. Any comments on Uber and Lyft and where that's going?
You know, no, the last I've heard is that it went negative for them, and that now they're considering pulling out of California business-wise, which isn't good. But in regard to how that's applicable for going back to the employee versus independent contractor, that may have an effect eventually, but I think the overall ABC test for California has been kind of the ruling law on that, which of course has been cracked down on considerably recently. But I would say that the ruling for Uber and Lyft can't be good, in that it's looking more and more like there's just a very definitive distinction between independent contractors and employees, and it'd be harder and harder to essentially get away with having somebody as an independent contractor going forward.
Yeah, it's going to be a tough one. The next question is, what if the employee is your spouse and wants to take advantage of, I'm not sure what the exact question is, what's to take advantage of tax-free, but what, how is it best for an employer to employ their spouse to the maximum benefit of the business?
Well, there's a double-edged sword there, if you will, in that you employ your spouse, and then of course there's not just the income tax factor, which kind of washes out, because of course, you know, you take a deduction at the business level, but then the W-2 is picked up on the personal level, so that washes out. But that means that the wages that you pay your spouse are subject to payroll taxes now, and you know, and so you got to find maybe the sweet spot where you got to maybe do enough to where they could potentially take advantage of a 401k plan or some type of retirement plans to the maximum ability. So you got to find that threshold. So it's kind of, you know, it's a moving target, but I think the sweet spot is more or less something that has to be kind of discussed with their personal CPA to find out, because it's definitely something that needs some projections and planning on the personal tax level. But, you know, again, those are some things to take into consideration, is that, yeah, you put your spouse on payroll, now you got to pay payroll taxes that you didn't ordinarily have to pay before, but at the same time, your spouse can then take part in, you know, retirement plan contributions and other, you know, fringe benefits potentially.
Got a question about PPP loans. So the comment is PPP loan is applied like income. Is SBA loan applied like income too?
Well, the PPP loan is an SBA loan. So to my knowledge, it is just a PPP loan that has tax ramifications. That is it. And not necessarily just the loan in and of itself. It's, you know, the loan has to be forgiven. So even though, you know, a business owner got a PPP loan and they're doing everything right, paying all the expenses that are supposed to be paid, payroll, rent, utilities, etc., at the end of the day, it all comes down to whether the lender and the SBA, I think it's, you know, potentially maybe it's just the lender's choice of if there's forgiveness of that PPP loan, 100%, or, you know, again, things are still being written, and it's a lot of things that still up in the air. But if it's not 100% or 0% forgiveness, is there like a middle ground? I don't know. But hopefully answer the question. There's the PPP loan is the only loan out there that is, if it is forgiven, has potential income tax implications.
And so the EIDL loan is not taxable, correct?
That is correct. And I was going to kind of say that there is a $10,000 grant that was provided with the EIDL loan? Is that what you said? There's a $10,000 grant portion of that. That is taxable income. But the loan portion, because it's not forgiven, that loan is not, there's no income tax implications on taking out an EIDL loan, just the $10,000 grant portion, because it's essentially, you know, you don't have to pay it back.
Right, we got one more question, and then I'm going to hand it over to Brianna to say a few
Okay.
words. As a veterinary associate, is it beneficial and possible to be hired as an S Corp? So I guess that means they would be paid as a corporation instead of an individual. If yes,
Or an independent contractor, basically.
correct. If yes, if the benefit of being hired as a corporation benefit the employer? If yes, is there a benefit of being hired as a corporation to benefit the employer?
To my knowledge, there is absolutely no difference between whether they are a 1099 independent contractor as a sole proprietor, or whether the independent contractor decides to incorporate and be an S corporation. Other than, there is that rule that, 1099 miscellaneouses don't have to be issued to corporations. So maybe that's where they're going with that. I'm not sure. I wouldn't necessarily advise, maybe playing that game, but that could be one difference, is that if you're a corporation, technically your employer does not have to issue a 1099 miscellaneous to corporations. And it's my understanding that it's, maybe only attorneys that it applies to, whether they're a corporation or not, get a 1099 miscellaneous anyway.
So, David, your email address is on the screen, davidl@dvmteam.com. Without throwing you under the bus, I'm also going to suggest that anybody who has a question that didn't get answered, or those questions that were asked that weren't clear, to reach out to you directly.
That'd be great.
Right. On behalf of the SCVMA, David Leckey, thank you so much. We were lucky to have Leckey today. Thank you so much.
My pleasure, and thank you. And again, I'm sorry. It was, like you said, it was like drinking from a fire hose. A lot of information, but my intent was to hopefully draw more questions to me. I welcome the questions and the challenge, and so if anyone has any further questions, feel free to reach out, please.
Brianna Hyman, can you unmute yourself or somehow? There you go. Brianna, the floor is yours. Please say a few words. Thank you. Let me see if I need to unmute you, but there we go. I don't know if I can unmute you, Brianna. You may have, there you go. Say something, Brianna. I think you're good. Brianna, speak.
Peter, this is her father. Every now and then you gotta watch the back of your kids. So we just want to thank the association again for allowing us to turn on the fire hose. And as David said, our gift to anybody who is listening today can contact David at his email there on the screen, no charge, and we'd be happy to get everybody the answer. We'll send it up to Peter. He could circulate it. And as I said in the introduction, don't do this at home alone unless you're a trained professional.
Bob, you sound just like Brianna. Thank you very much, Bob. Thanks, Brianna. Thank you for Diversified Veterinary Management. And thanks to all of you attendees who are on the call today. Be looking for your SCVMA, your email from Zoom tomorrow to get your CE certificates and evaluations. Everybody stay cool, stay safe, stay sane. We'll see you next time.